Today we're going to look at the market crash. We're going to look at what indexes are down, how far they're down, and what the best thing to do in this market crash is. Welcome back to the channel, guys. If you're new to the channel and you haven't subscribed already, you're enjoying what you're seeing or will enjoy the content, I'm sure, head down and subscribe to the channel so you don't miss out on any future videos. And while you're down there, it really helps out to give it a little like as well and make comments throughout the video. If you've got any questions or want to make any comments, then comment down below. We're gonna have a look at the market crash. We're gonna have a look at the crash as a whole. I want to start the video by saying it's not really a crash as yet. We might be heading into a minor correction at this stage, although we've had a small rebound today. Yesterday it was looking pretty red and pretty dire, and I think the figures for the S&P 500 as a whole, the FTSE 250, NASDAQ and things like that were far worse yesterday than they are today. Are we already seeing a small bounce back from our crash correction? I don't know, we'll have to have a look into it, and I'll give you some ideas of why I think the market's sort of having that reaction so far this year, because it's not been great this year so far, and give you my view on the best and safest places to be putting your money. So let's look at the market as a whole. So the S&P 500 is currently down about 8.8%. I'm sure yesterday it was around 10%-ish. So we had a small bounce back on the S&P 500 today, and the NASDAQ is around 10.8% down year to date. And again, I'm sure that was closer to 12%. Yesterday, 12 point something percent yesterday. We have seen a small bounce back since yesterday, and it'll be interesting to see a lot of videos on YouTube. A lot of the YouTubers who are coming out with the crash, what to do. Of the larger YouTubers like me, Kevin, was selling out of all their stocks and things like that. I don't know whether that is a case of views, clicks, he actually genuinely wanted to sell out. I don't know, to be honest, I've not watched the video, but you see all these thumbnails of the market crash, I'm selling out, this is what I'm selling, or this is what I'm doing. I'll go through exactly what I'm going to be doing in this market, as is the case with any market, and you probably know exactly what I'm going to be doing in this market, as well as a bull market and any market in between, but I'll go through all of that a bit later on. The main bits of information you will probably need in this video is reasons why the market is doing what it's doing so far this year. If you're a long-term investor, you probably have no fears or worries and you can't wait for the market to go down. If you've been investing in any kind of market for the short period, you're probably seeing quite a lot of red in your portfolio. And if you are investing for the long term, you need to not let that scare you in any way and panic sell out of positions that you were quite comfortable with before you started seeing a little bit of red. Reasons the stock market is looking like it's crashing so far this year is a mix between interest rates potentially going up, the fears surrounding interest rates potentially going up, inflation rates both in the US and the UK being at 30-year highs or something like that, the price of energy, the price of fuel, the price of clothes, and the general price of everything across the board. I think other than maybe food, don't know, but certainly petrol prices, energy prices and clothing has been going up substantially more recently, and that tends to have an impact on the stock market. And the rate at which the US is quantitative easing is slowing down as well. They're not pumping the market full of cash or quite as much as they were, and that's going to have an impact on the market as well. So those three things are going to have an impact on the market and have had an impact on the market so far this year, which is why we're seeing all the red in the market, the S&P 500 and the FTSE 250 and the NASDAQ, and even the European market. I think the European market as a whole is also around 2 to 3% down year to date. So these are my thoughts, and this is what I think you should do. I'm going to break this down into two sections, one index funds and two individual stocks. If you are a long-term investor and you're going to be spending time in the market as opposed to timing the market and trying to time the very bottom of the S&P 500 so you can get in and it goes up, rather than do that, think about instead spending time in the market. And you can do that by doing a thing called dollar cost averaging, which is as soon as you have the money to invest, whether it's weekly or monthly, you put it into the market regardless of where the market is. For long-term investors, this is crucial, because the money spent out of the market will lose more than you'll gain by timing the best opportunity in the market in terms of getting into the market. So index fund investing, and if you're looking at ETFs, the S&P 500 as a whole, or emerging markets or high growth stocks, but ETFs as a whole and markets as a whole, the Nasdaq, the S&P 500, the FTSE 250, you're best off just in the market, dollar cost averaging for the long term, and don't worry about these small corrections and blips in the market, because on the long term, it's going to or should only do one thing, and that's go up. Now, if you're an investor in individual stocks and you're looking at individual picks and you think, I love the look of Disney at the moment, or Netflix at the moment, or Peloton at the moment, Netflix being a real performer in the pandemic, Netflix now has absolutely plummeted more recently for reasons I'll go into in another video. But if you're looking at that as a singular stock and it's just dropped in price and you want to time the market, you think let's get in right at that moment, be more cautious of getting into an individual stock than an ETF or the overall market like the S&P 500. If you're getting into an individual stock, you need to take particular care and meticulous care in researching the stock as to why it went down in the first place, what it has in the future, what the plans are, what its revenue is, what its revenue growth is, what its income is, what its profit is, and what its price to earnings, and the metrics you typically look at when valuing a stock or a company, and look at potentially its future a lot more than an index fund or the overall market. Now, from my point of view, the easiest and safest way of earning money in the stock market is either with a very reliable stock ETF or income fund that has a very good track record of paying dividends. You're going to earn money from that because you have return on your capital, or you get into the overall market and you look at this as a long-term strategy, very long-term strategy, in which case get in now, get in next week, get in next month, get in the month after, get in the month after that, and dollar cost average. Get your money into the market working for you every single month, every single week, as often as you possibly can. A strategy like that is going to be far more beneficial for you as a retail investor, especially if you're relatively new to this and you want something simple and reliable. That's going to be a great strategy for you moving forward in a market that is very bearish and you're seeing a lot of red. That's going to spook a lot of people. That will probably spook you. People that don't know about this or aren't in the market regularly can often sell out, panic sell their positions because they're seeing the red and they're seeing minus £1,000 and they think, I can't afford to lose anymore, I'm going to get out. Now, if you're long term, you don't need the money, you just hold the position, probably buy more because it's therefore a discount at that price, and you'd see it just ride up whilst dollar cost averaging throughout the years ideally. So that was a really rambly video. I'll try and break it up with a few snippets of pictures and graphs and things, just so it's not as boring as it probably will be, but just wanted to get on and talk about the market crash and how obviously it's not an issue for most people if you just look at this long term and dollar cost average. It's only going to be an issue for you if you need the money and you're looking at this as a very short term play. Again, sorry for the rambly video. If you're still here and you like the content and you like the message, subscribe to the channel for more videos so you don't miss one, and like the video as well. Pop a comment down below what you're doing in the market, what your strategy is for this year. I'm looking forward to hearing your thoughts, what you have to say, and I'll wrap the video up there and I'll catch you guys in the next one. See you later.